Welcome to The Open right here on BNN Bloomberg. Let's get to the big stories we are bringing you from our newsroom. The United States added 130,000 jobs in January, topping expectations, and the unemployment rate fell to 4.3%. The U.S. Labor Department also adjusted, sharply cutting prior job numbers stretching back nearly 2 years. That report was delayed due to a brief, partial U.S. government shutdown. Gibson Energy, the big player in oil transportation and storage, is buying an outfit called Chauvin Infrastructure. It's a $400 million deal, and it includes the purchase of a crude oil pipeline and associated infrastructure that connects Chauvin to the Hardisty oil hub in Alberta. The acquisition will enhance Gibson's heavy crude oil network by extending its reach to new and established producers. The company also announced a $200 million equity offering. Revenue and profit in the latest quarter at Intact Financial beat analyst estimates. The Toronto-based insurance giant says strong performance across all geographies, along with solid underwriting results, helped drive the quarter. The CEO says Intact is well positioned to achieve its goal of 10% annual profit growth over the next decade. And the company is boosting its dividend by 11%. There's a look at U.S. stocks. Looks like they are going to be higher today, even though these strong U.S. job numbers may reduce the likelihood of Fed cuts. We'll have more on that shortly. And let's have a look at how the TSX ended yesterday. It closed at a new record high. Let's have a look at oil this morning. Investors are awaiting signs of progress on those talks between the U.S. and Iran over its nuclear program, although there are fears that the Iranian regime is just saying, nah, that's Farsi for no to everything. Let's have a quick look at gold, see how that's trading. Yep, holding in above 5,000. So certainly, despite the reduced chance of interest rate cuts in the States, if that's what these job numbers mean, bullion is holding in. And let's check out our dollar, the Canadian dollar, down slightly against the US currency today. And finally, Bitcoin. Let's have a look at the biggest cryptocurrency. And you can see it is under pressure yet again. Let's get perspective on today's news from Ross Healy, CFA at Strategic Analysis Corporation. Ross, great to see you as ever. Comment on these U.S. job numbers. Have you had a chance to check them out?
Yes, and they're actually, Andy, they are consistent with the trend that has been now in place for some time. Now, broadly speaking, very, very slowly improving, changing. But after you've said that, just enough probably to put off having the Fed do a rate cut to preserve the job outlook. I think that would be the best way that I would put it.
What is your feeling on the U.S. economy in general, Ross? So we do have these imbalances between high-income and low-income people. And of course, that has hurt results for some companies.
Yeah, we are fairly optimistic looking at the U.S. economy for this year. Nothing very exciting, Andy, or flashy, but I think steady progress in the order of probably 2, 3, 4%, something in that order. There is nothing, I think, to prevent that from occurring. And as I say, we are optimistic for 2026.
What is your feeling on gold, Ross? What signal is that sending with gold hitting new record highs this year?
Well, looking at gold is really interesting, Andy, because it sort of spiked up to 5,600 and a little bit, and then dropped a sharp $1,000 or something in that kind of order. In other words, it's the kind of volatility that you would expect when a commodity spikes up to a new all-time high. Now, after that, what has been going on is that there has been a slower, more steady increase on a daily basis on the in the price of gold. And what is really interesting about that is that when we look at the stocks themselves, okay, they had run up on that 5,600 thing, dropped down, and they are now trading more cautiously than they had previously. In other words, the market has been spooked by that spike. However, when we take a look at the earnings for the gold companies, I think they're going to be real blockbuster blowouts, and I suspect that investors will gain some confidence once again in the stock prices.
Would you be a buyer of big gold producers right now, though, Russ?
Yes, I would, and particularly, I think the really high quality stocks. I always think of Alamos and Agnico Eagle, but at this juncture, practically any gold stock, I think, is going to work out well. And when you look back in the history of gold price movements, there's the sort of the slow, and then you start going up the exponential curve. Well, we haven't seen that quite yet. We almost got it, but what happens in those cases is that you suddenly get the American investor starting to come in, and when they come in, then watch out, things can get really, really interesting.
You note local opposition in many parts of the states to these new AI data centers. Partly, of course, there's concerns about local electricity rates going up, water usage in other parts of America. Is that an important feature? Do you think it could turn into a real roadblock for growth of AI spending?
Yes, Andy. I think one of the biggest news comes from New York, where those new AI server farms are being blocked by citizens and politicians alike, and that movement is spreading across the states because people are saying, you're not going to plug into our local electricity source and drive up the cost of electricity. And where do you think you're going to get 300,000 gallons of water every day to cool these wretched things down? And I think there's going to be there is now a real backlash. We have my son actually coined a term for it. He called it NIMBY, not NIMBY, but NIMBY, meaning no AI in my backyard. And as I say, that is really spreading across the states. So far, it does not appear to have particularly hit the what I would call the AI stocks, the chip producers and so on. But if you slow down that hope for estimated growth by a substantial margin, which very much appears to be the case, then eventually there's going to be quite a backlash because these stocks are so expensive.
We've only got about 30 seconds left. Ross, Verizon is a stock you're interested in right now. Tell us why. I'm sorry we're so tight for time.
No, that's fine. Listen, Verizon has been growing very nicely and steadily all the way through the piece and has a heck of a dividend yield. Now, the stock got bashed down because of concerns about its growth, but the company has been working very, very hard to improve that, and the market now appears to be saying, yes, I think that's going going to be the case. When we originally recommended the stock, we had thought that it probably had a good solid upside of 33% or more. But if the market really, if those numbers start to come through, which they're promising, then the stock is very, very cheap relative to its long-time highs and could move higher and maybe a lot higher.
Why? Sorry, can we just put up that chart again? I don't know if there's a problem with the chart, but we just saw a spike in Verizon, it looks like. Yeah, I don't know if that's some artifact, some data glitch. Yeah. Anyway, but thank you very much indeed. I really appreciate it, Ross.
Okay, Andy, my pleasure.
Ross Healy, CFA at Strategic Analysis Corporation. Up next, we are going to break down the latest U.S. jobs data. We've seen a sell-off in bonds today. Some investors fear it will deter the Fed from cutting borrowing costs. The U.S. job economy, job market seems to be doing just fine. America added 130,000 jobs in January, and unemployment dropped to 4.3%. Let's get more on this from Gennady Goldberg, head of U.S. rate strategy at TD Securities. Gennady, always great to see you. What jumped out for you with this jobs report?
Well, it's really the unemployment rate, to be quite honest with you. I mean, the job numbers themselves were certainly quite strong. We had some upside surprises, definitely not enough negatives to go around. But that drop in the unemployment rate to 4.3, which is roughly the Fed's estimate of NAIRU, the basically kind of the steady unemployment rate, that's going to give people pause. That's going to really tell the Fed they're not in a huge rush. They don't necessarily have to go in the very short term.
That's interesting. I mean, it's only 1 month. Is there any indication as to why U.S. employers are feeling optimistic and they're hiring?
Well, if you dig down into the jobs data itself, we did see some pretty serious gains in healthcare and education. And that's been a category that's been driving a lot of the job gains. This time around, it drove more than 70 or 80% of the total increase in employment on a month-to-month basis. So the sectors are definitely more concentrated. It's not really a broad-based recovery. And as you mentioned, this is 1 month. I think what it does is really take the heat off the Fed to go necessarily at the March meeting. But they're going to keep watching. This is not over yet. They know that the labor market is going to be quite jumpy on a month-to-month basis. What they really look at are trends. They tend to look at 3-month trends, 6-month trends. This is just one data print to them. But I think for markets, this really helps the markets lower the pricing for March and potentially even April rate cut pricing.
Maybe we could put up a 1-year chart for the U.S. dollar. Now, we did see U.S. bond yields rising, people selling bonds today. They often do that when they see borrowing costs stay stable. And I know the Fed doesn't influence bond yields directly, but it looks like this is causing ripples in the longer-term debt market.
Yeah, and what this really does is kind of influence the very front end of the curve. We did see a sell-off. It was actually a curve flattening. So the front end actually sold off more than the long end. For me, this is just a function of the market pushing off the first rate cut, modestly increasing the Fed's terminal rate pricing. So, for example, where they expect the Fed to really end the cutting cycle, that's gone down into the low 3s before this print, and it's popped up a little bit after that. So what this really means to me is a little bit more patience for the Fed, not necessarily, a Fed in a rush to cut interest rates. And it really complicates the job for, incoming Fed Chair Warsh as well, who's, has been appointed with the promise of additional rate cuts.
That's interesting. Sorry, what does it mean for Kevin Warsh? Give us that again.
Yeah, what it means is Kevin Warsh is going to really have a bit of an uphill battle potentially convincing the rest of the committee that additional rate cuts are necessary. We've seen in the last month or two the committee just become much more cautious as we get closer to their estimates of where neutral is. They see neutral somewhere in the range of about 275 to basically 375, with the core of the committee somewhere between 3 and 3.25. Now, as we get closer to that, the debates just get more and more intense. Kevin Warsh is going to have to go really out of his way to convince the rest of the committee that they must cut rates immediately, that they must cut rates rather quickly. It's going to be tough for him to convince the committee if you continue to see labor markets behaving the way they are and inflation the way it is. Something's going to have to change. So I don't think by any means anything is over. We're going to keep watching every single month payroll numbers. But for now, at least, I think it's a bit of an all clear for the Fed to stay on hold.
Would you be a buyer of U.S. 10-year bonds right now? Say your horizon was 5 years and you were looking for a capital gain. I mean, in other words, do you see the U.S. 10-year yield coming down or going up over the next 5 years? I know it's a very simplistic question.
No, that's and it's actually a really great one. What we've seen recently is a big rise in the term premium. So this is kind of the estimated premium that an investor gets for holding longer dated interest rates.
Gennady, kind of a risk premium.
Exactly.
Right,
it's a bit of a risk premium. So effectively, I think this is actually quite attractive at the moment for 10-year Treasury yields. That premium, according to the New York Fed's ACM model, is about 80 basis points. I think over a longer horizon, that's actually quite attractive for investors. I think around 410 to 430 on 10-year rates is an attractive entry level for the longer term. I think for investors who are worried about the short term, and I think that's what's keeping a lot of folks away, there is a little bit of worry that we can shop around in that range, or potentially, yields could move a little bit higher short term. But I think for the next couple of years at least, these are going to be fairly attractive points to enter. The issue is, again, investors are worried about some of the short-term risks to economic data, the Fed independence, and all sorts of things.
Just finally, there was a revision to the U.S. job numbers, apparently, and it showed a slowdown in hiring for the prior year. Do you attach much weight? The numbers were too optimistic, it sounds like, or too high. Do you attach much importance to that?
The statistical folks actually do some surveying on really investor expectations for the revisions. The revisions were just marginally larger than expected. There are annual revisions every single year. Mm-hmm. What this tells us is really what we already know. The labor market wasn't quite as strong over the last year as people thought. We already thought it was weak. This just kind of gives us a better sense of just how weak it was. I don't really attach much meaning to that for the go forward. I think it's extremely interesting to see on kind of a backward looking basis. But what matters on a go forward rate is firm sentiment around hiring, generally hiring expectations, and really what happens in the last couple of months. And that's why I think the Fed is looking at 3 and 6 month moving averages of payroll gains and the unemployment rate for a clearer read on the economy.
Gennady, thank you very much indeed. Really appreciate it.
Thanks for having me.
Gennady Goldberg, head of U.S. rate strategy at TD Securities. Up next, the Prime Minister has been trying to dial down tensions after U.S. President Donald Trump threatened to block the opening of the new Gordie Howe International Bridge. U.S. President Donald Trump's latest dispute with Canada is over the opening of the new Gordie Howe International Bridge between Detroit and Windsor. CTV's Mike LeCouture has more on the Prime Minister's response.
Canada, of course, paid for the construction of the bridge, over $4 billion.
Prime Minister Mark Carney said he laid out that fact to President Donald Trump in an early morning call that he described as positive. He also cleared up Trump's misconception about the construction and ownership of the span.
See, there's Canadian steel, Canadian workers, but also U.S. steel, U.S. workers that are involved. This is a great example of cooperation between our countries.
Contrary to Trump's claims, the 2017 agreement clearly spells out that the crossing will be publicly owned jointly by Canada and Michigan. Yet Trump's officials insist there are issues.
There's a question as to the proceeds of tolls, et cetera, and so there's going to be a negotiation on that front.
The agreement states Canada will collect tolls until it recoups the costs related to construction. After that, they're split between Canada and Michigan. One former ambassador says there's a reason the president gets things so wrong.
You've got a bunch of crackpot advisors in the White House who misinform the president, who already likes to have tantrums and lash out.
The New York Times is reporting the owner of the older Ambassador Bridge, Matthew Maroon, lobbied the Trump administration on the same day the president unleashed his tirade about the Gordie Howe ban.
The Maroons are the only party that benefits from delaying the bridge. They make a lot more money at the expense of Canadian and American consumers and everyone else.
Ontario's premier believes there's an economic argument for the new bridge, which could spill over into the American midterm elections.
If, the 13 Congress people, 7 are which Republicans, they start getting hammered by their constituents, watch how quickly they flip.
But before that happens, Prime Minister Carney says President Trump asked his ambassador to Canada and Michigan native Pete Hoekstra to continue the conversation and bridge the apparent gap.
CTV's Adrian Gabriel gauges reactions from businesses.
Spanning 2.5 kilometers across the Detroit River, a long-promised economic driver could be forced to take a detour.
We're home to the busiest commercial border crossing between the U.S. and Canada. This is insanity.
While President Donald Trump's political speed bump threatens to derail the planned opening of the commercial corridor, some industry leaders see an opening to accelerate negotiations.
As of a few weeks ago, conversations weren't happening between U.S. and Canada. They were stalled.
Nicole Vlanich, the executive director of the Canadian Association of Mold Makers, says the U.S. president's bluster doesn't surprise her, even though Trump has previously supported the project. This joint statement, released by President Trump and then Prime Minister Justin Trudeau in February 2017, says that we look forward to the expeditious completion of the Gordie Howe International Bridge, which will serve as a vital economic link between our two countries.
It's right. I mean, it is vital. I think we need the second bridge. It's been talked about for over 20 years, why it's needed.
Political leaders in Windsor and Michigan say they're united by a common goal.
This bridge will open. It's fully constructed.
It is important that it continues to move forward and open up on time.
What would any delay to opening this bridge mean for your industry and the industries here in Windsor, Ontario?
When we think about job growth and job potential on both sides of the border, it would delay that.
The bridge is expected to increase the current $1 billion per day in trade that flows through the Windsor-Essex region, while creating a smoother commercial alternative to the Ambassador Bridge.
If there's an issue with one bridge, they can go to the other. It'll stop the traffic delays.
With negotiations now reopened, the hope of many here is that a clearer path will be paved for future economic growth.
Some local business leaders here, as well as politicians, believe the Gordie Howe Bridge is simply being used as leverage by President Donald Trump as he pushes to negotiate a wider America First agenda. Adrian Gabriel, CTV News, Windsor, Ontario.
The opening bells are next. And here are the opening bells on Bay Street and Wall Street at the NASDAQ. Solve Energy is doing the honors in New York. It's AGI. It's time for the first 50. Let's check in on the equity markets as we get going on this Wednesday morning. The TSX pushing further into a record territory. New high for our composite index. Let me just check on the S&P 500. It is up as well, up 1% or almost 1%. And 6,990, yep, it looks like it's trading in record territory as well. Still can't get to that 7,000 level and stay there. And there's the NASDAQ also higher. Some stocks of interest in Toronto. Let's have a look at Allied Properties. Look at that, more than 20%. The company coming in with cash flow that was down 22% year over year. But the big deal here, Michael Emery, the longtime CEO, departing from the board, and the company also recapitalizing by raising $500 million. It's also taking more than $1.1 billion in a write-down and an impairment. And Desjardins predicted we expect the stock to be very weak on the back of these results and the related equity recap plan. And sure enough, investors are not pleased. Let's have a look at Cineplex. Revenue slightly ahead of expectations at $334.8 million. Attendance was just over 10.1 million. That was down from, or missed the estimate of 11 million. However, concession revenue still healthy, $9.92 a patron. So the average person spending almost $10 on popcorn and stuff, and the estimate was $9.71. And Shopify, analysts liked those numbers. The stock was up in the pre-market. Strong holiday spending boosting revenues. And we're going to have more on Shopify later on the story. And finally, I just want to close out something. Let's put up Verizon again. I was curious about that spike lately over the past month or so in the stock. It was more obvious on the one-year chart, if we can put that up. It looks as though just Wall Street is warming up to this telecom giant. In early February, the chief executive, Dan Schulman, won praise for his transformation from JP Morgan. Analysts, apparently the company just logged its best phone ads in 6 years. So, that chart's right. Debt, though, is an overhang for this company. Let's get some movers south of the border. We're joined by Jeff Morgan, Deputy Team Leader for the Bloomberg News Equities team. Thanks very much for joining us, Jeff. Talk to us about Generac. What's going on there, please?
Yeah, Generac is the top performing stock in the S&P 500 so far today. This is a company that sells generators. Primarily, they get a lot of their business when you see these weather events, knockout power and power producers in the United States. They had a little bit of a weaker quarter than expected in the fourth quarter, and so they sold a fewer of their generators to people affected by hurricanes and other weather events. However, the commentary this morning from the CEO saying that they expect to sell more generators and see a backlog as hyperscalers, so those big mega cap tech names have created potentially a backlog of demand. The demand for power in the United States is just kind of through the roof and growing as a result of the build-out of data centers. And now it seems, we've known this for a little bit, but it's starting to show up in the share price this morning of Generac. Those data centers apparently are going to require some generators as well.
I guess, they can't go down. For example, people wouldn't be able to watch their cat videos or buy stuff, buy the junk that we keep filling our houses up with. Moderna got a setback on a flu shot.
Yeah, from the top of the S&P to the bottom, Moderna is the worst performing stock in the index so far this morning. Big surprise, and looks like the company itself was surprised as well. The FDA said this morning that they were not going to review Moderna's mRNA flu vaccine. And the company came out this morning and said this is inconsistent with previous communications that they've had from the FDA. Looks like they were surprised, and certainly looks like investors were surprised this morning as well. Stock is down 11%. As I mentioned, this was the worst performing stock in the pre-market session, probably on its way to being the worst performer in the S&P in regular trading as we get underway today.
And then the rout in crypto prices hurting Robinhood's profit?
That's right.
Or
Robinhood
revenue, sorry,
also
Jeff.
among the worst performers in your revenue and profits. It's all red for Robinhood, at least when it comes to crypto trading. This was a poor performing stock this morning, and really, as you mentioned, it's that crypto rout that we've seen over the course of the fourth quarter, and that's really continuing just in the last few weeks, which is weighing on things here. Robinhood users like using the platform to trade Bitcoin, Ethereum, other cryptocurrencies, and the drop in revenue from trading those currencies is quite pronounced. We're seeing a 34% drop in net income in the fourth quarter, and revenue from crypto trading fell by 38% to $221 million in the quarter. So these are great big declines. The stock is down as a result. It was already down 24% this year. Now let's add that 8.7% so far to that route so far today, and we are seeing a stock that's under a lot of pressure as a result of this crypto crypto rout that we've seen, not just this year, but kind of for an extended period now over the course of the fourth quarter and into this one.
Jeff, thank you very much indeed. Bloomberg's Jeff Morgan. Up next, we're going to take a closer look at those Shopify results. Investors bidding up the shares. It looks like the company had a good holiday season. Shares in Shopify higher after the company forecast quarterly revenue above estimates. And the holiday season was decent. Plenty of flow through Shopify's ecosystem, as they call it. Let's find out more, though, about Shopify's artificial intelligence strategy. We're joined by Sri Iyer, lead portfolio manager and head of investments at Guardian Capital. Great to see you.
Thank you.
We do know that Shopify is using AI extensively. They've actually teamed up with some of the big AI engines to make it easier for people to shop directly using them. So are you impressed by their strategy so far?
So first of all, Shopify beat revenue by 30%. Big day. Everything is on track. But what we're laser focused on is their agentic e-commerce implementation. I think there's much more to go in that space. So we feel that overall, if the e-commerce supply chain could be automated by Shopify, I think that'll be a big advantage for them. We're laser focused in looking at that.
What do you mean automated?
So agentic e-commerce or agentic commerce is the biggest focus right now in that part of the business. So much of the process automation, that is, rather than having a SaaS AI framework, you actually have agents or AI agents actually doing the work for consumers. So that's the next stage that we see happen.
Sorry, just to make sure I have it straight. Sorry to interrupt. That means that when I'm dealing with Shopify, it's as though I have a human being helping me with my shopping.
Correct. But it's an agent. It's an artificial intelligence agent. So it becomes more prescriptive than predictive. That is, it's an agent that is actually helping you shop. And it's also helping the manufacturer to sell in a more efficient way. So this evolution in artificial intelligence is a game changer for Shopify. And we're seeing that they're starting with a strong footing here. Strong revenue, strong cash flow, strong buybacks. And they're using about $140 million in share rewards. So they're not what you call whitewashing. Their buybacks are very strong, but they're also rewarding their employees. So I think these are all very positive responses. The stock is priced to perfection. But if the implementation of AI is strong, I think you should see further upside.
But you haven't been buying it lately because of the valuation?
Correct. It's priced to perfection, and there's been a lot of volatility because you're seeing a lot of confusion in the market when it comes to how the AI adoption is going to work for a lot of companies. Shopify has got two core models, right? It has its payment model, and then it has its SaaS AI model, software as a service for users. That's always in a state of flux right now with Claude Code and everything else coming to the market. So it's going to be very interesting as to how does Shopify navigate that market space, and how does it entertain small businesses that are going to use more simplified architectures, much more cheaper to start their business. So that'll be a big, interesting area for us to watch very closely to see how does Shopify tap that market space.
It's interesting that people, it seems, are willing to trust AI, maybe to too great an extent, people using them for psychotherapy, and concerns have been raised about that. I mean, this is perhaps a little less sinister. We're using it to help us shop, and we trust them, it seems, these agents.
We very much trust them. It's an evolution of artificial intelligence. So we have been using AI in stock picking for like 8 years now, from machine learning to deep learning to large language models at Guardian. And now we're using agents, artificial intelligent agents, to give us inferencing ideas and conviction. This is not just in the investment field. It's happening pretty much in every aspect of business today, in every business. So we feel that monitoring that framework to see how Shopify monetizes that experience with customers is absolutely critical. And I think they're on it, being a technology company. But you should not throw the baby out with the bathwater, in the sense that SaaS AI companies that are struggling with AI CapEx right now, some will work, some will not work. But that's our job, to make sure that we figure out which ones to do and which ones don't.
What about Alphabet? Is that a stock you'd buy with new money now?
The biggest areas that we're focusing on right now with opportunities are any company that is AI native. what I mean by AI native is companies that have artificial intelligence as a foundation of all aspects of business. Google or Alphabet now is an AI native company. Its whole infrastructure is based on artificial intelligence with a global reach to the clients. This type of opportunity set gives them an oligopoly-like response. In my opinion, Google is not a tech company. Google is an AI utility company. It is an enabler of artificial intelligence, which is going to be a necessity for anyone doing business in the world of artificial intelligence, along with a couple more competitors in that space.
And Gemini is part of that, their AI
Google
engine.
Gemini is very much part of it. And in our world of artificial intelligence, we compare Gronk, Gemini, OpenAI. These are all competitive frameworks, but Google Gemini is one of the leaders when it comes to reasoning and other types of LLM models.
Intuitive Surgical, famed for robotic surgery machines, and AI will help there.
Another great company. AI has already helped there. Intuitive Surgical is integrating artificial intelligence into robotics, into diagnostics, into imaging, into algorithms. So the future of medical sciences goes through Intuitive Surgical as far as robotic operations and well-being goes. We like the company, strong earnings, strong cycles of visibility when it comes to AI implementation.
I remember my uncle in Victoria, BC, who was a doctor. He said, you know this thing about brilliant surgeons? He said, it's just experience. And he was being a little facetious, I think. But he said, just how long you've been doing it. But I guess AI can learn and can incorporate experience.
Very much so. I mean, the implementation of AI chips into robots, where it has a lot more reasoning and precision, is extremely critical. A lot of serious operations going on right now are being done robotically. So I think the confidence level of society in general to use artificial intelligence is permeating virtually across every aspect of life.
And what about Apple? The cliche here is it's been a laggard in AI.
In my opinion, Apple is one of the most undiscovered AI companies in the investable universe. The definition of native AI for Apple today is edge computing. Apple is going to bring artificial intelligence everywhere, but invisible. It's not going to be flashy. Your smartphone is going to become your AI apparatus. The human connection between using AI, implementing AI, and understanding AI is going to go through the smartphone. So we are discounting the impact of the connections between Google and Apple, the recent deals they've made, and how edge computing is going to get on the phone. So on your phone AI is going to be the future, and it's going to be the best friend of any human being in the future. So we are extremely positive about Apple's migration towards edge computing versus trying to build out its own large language models or try to compete with some of the bigger players in the enabler side. So I think the market's not exactly sure how it's going to be played out, but in our opinion, Apple has one of the biggest ecosystems and distributions. All it needs to do is to plug the right AI into its phone, and you're going to see a transformative response to markets.
And this is, you're talking about Apple using Google's AI technology.
Apple using Google's AI technology as AI native on the phone itself, so it becomes a living, breathing assistant for you in future.
Yeah, I'm pretty impressed. I can ask Siri when I'm driving, you know, open up Spotify and play me something. And I know that's just primitive compared to what you're talking about.
It's going to be very primitive when they come out with the rollout with the new AI native framework.
Thanks very much.
It's a pleasure.
Sri Iyer is a lead portfolio manager and head of investments at Guardian Capital. Coming up after the break, we will break down Shopify's latest results. Shopify shares have been higher this morning. The e-commerce company beating expectations after a strong holiday season. Let's get more from C.T. Panigrahi, Managing Director at Mizuho Securities. Thanks very much indeed for joining us.
Thanks for having me.
Gross merchandise volume and revenue up more than 30%. The market seems impressed.
Yes, that was a pretty strong quarter. I mean, they beat across the board. Its GMV was 31% versus expectation was around 28%. But also, if you look at merchandise, merchant solution revenue, that was up 35%. Versus expectation was 32. So it was a pretty strong quarter across the board, but also the guidance was strong too. They guided also above expectation. That was another reason you can see a strong beat as well as guide. So revenue low 30% versus expectation was mid 20%.
Now, Shop Pay gross merchandise volume was up more than 60%. But I mean, I'm not a huge internet shopper, but I don't recall seeing Shop Pay as an option. But maybe I just haven't been on the right sites.
Yes. So what Shopify is trying to do is for the merchants, they're offering different channels for them to sell to different consumers. So, and Shop Pay payment is one of the key driver for merchant solution growth. Whether you have your own website or you're trying to sell it at, whether at the Google search or social commerce, they're everywhere as a checkout button. Yes, I mean, you have not seen that, but probably you're not shopping at one of the Shopify merchants. But yeah, that is one of their key strategic, goal at this point.
Shopify stock, maybe we'll put up a 5-year chart, is down from its highs. Why are investors more cautious these days than they were more than a year ago, for example?
Yeah, I mean, if you see last few years post-COVID, stock came down because, in fact, their growth decelerated. But last few years since post-COVID, if you look at the GMV growth, has been accelerating from 19% to, last year, 24%, and 2025 was 29%. They're trying to re-accelerate their growth. But lately, what you have seen is that AI disruption. That has been a, right now, key concern across software, and investor looking at Shopify as another software platform for merchants. I think that is why at this point you see stock underperforming.
Actually, sorry, the stock actually peaked more recently in late October at about 249 Canadian. So it was pretty recent, the peak. Do you feel those fears, those software, AI disrupting software fears are overdone?
I think so. I mean, there is a little bit of, I think it's overblown, but the way investors look at first is, they try to penalize everyone in overall software, then they'll try to handpick, like look at individual companies. So Shopify, they think it's a software platform, but effectively, if you see, this is the execution platform for any e-commerce vendor right now, any merchant. So it is not a software that you can do vibe coding. They own the mission critical execution layer at this point. And the other point is agentic commerce. That's the new trend that's coming in, and they're investing heavily there. If you think that's the next future, from social commerce to search commerce to now agentic commerce, they're well positioned there. So time will tell, but I think, yes, at this point, the fear is a little bit overblown.
And agentic is where the AI just acts as a sales or really a customer assistance person. It's not a person, but it'll help answer my needs. It won't just address questions like it's talking to everybody.
Yeah, so you think of that's from a consumer perspective for you and I. But for a merchant, if you think that's the future, a merchant wants that channel. They want to capture that channel. If you're in the Google search, they want to be seen. If you're at the TikTok, they want to be seen there. Now, if you think you and I are going to go to ChatGPT for our shopping, a merchant wants to be there so that you buy their products. And what Shopify does, it helps those merchants. They help enable that agentic commerce as a channel. So whether or not we'll see how the adoption will take off, whether you and I will use an agent to buy goods online, but at least this enables those merchants, Shopify enables them to be available at that ChatGPT or Claude.
Thank you very much, CT. Really appreciate it. CT Panigrahi, Managing Director at Mizuho Securities USA. Coming up, we'll take a look at some of the stocks moving on Bay Street. Bombardier is higher after getting a big order. Okay, let's check in on the equity market. The TSX hitting a record high when trading started today, and it's still up there at a new record, up only about 1/5 of 1%. I know, but yep, trading poised for a new all-time high. One stock on the move, Bombardier. It won a 40-plane order for its Challenger 3,500 business jet from Vista Global Holding, which is a huge operator of business jets. Apparently, there's global demand growing for private aviation. This deal is worth about 1.2 billion US at list price, but buyers tend to get big discounts for bulk purchases. The planes will be delivered over a decade. Vista is based in Dubai. It was founded by Thomas Floor, and it offers customer subscriptions to planes as an alternative to owning their own aircraft. And let's have a look at some stocks under pressure on the TSX. We'll start off here with Finning. Finning International. Oh, look at that. Shopify now down. Finning, apparently, according to TD, came in with an adjusted earnings before interest and taxation miss. It was 209 million. That measure of profitability, but it was about 5 or 6% below the street. However, the forward indicators, according to TD, which is a buy in the stock, are positive, including a record backlog for the dealer in heavy machinery. Shopify now down, and I haven't been able to detect why. I was looking for a big sell-off in those software as a service shares in America. Haven't seen anything along those lines, so we'll have to just leave it there. But Shopify did post a strong quarter after plenty of volume came in over the holiday season. Salesforce is down, so maybe that's it. Investors selling some of those traditional software stocks amid AI fears. And Adobe is down as well. That's kind of a poster child for the concerns. Okay, and maybe a very quick look at Allied Properties. That one tanking, AP.UN, and they announced weaker than expected results. Michael Emery, the former CEO, is leaving the board, and they're raising about $500 million in shares to rebuild the balance sheet. Just ahead, we got a slew of earnings south of the border, including Ford, Lyft, and Mattel. Welcome to the second hour of the Open. Let's check out the big stories we're bringing you from our newsroom. Bloomberg News says U.S. President Donald Trump is privately considering exiting North America's trade pact. According to the report, Trump has asked his aides why he should not withdraw from the agreement, COSMA, as we call it in Canada. U.S. Trade Representative Jameson Greer said the administration would hold separate talks with Mexico and Canada. That Canada-U.S.-Mexico trade pact is set for a mandatory review before a possible extension on July 1st. Shopify beat revenue estimates in its latest quarter. Revenue, in fact, was up 31% year over year. The company says it is setting the foundation for a new era of AI commerce. It's also buying back up to $2 billion US worth of shares. The stock was up earlier, but since has been selling off. Revenue in the most recent quarter at First Quantum Minerals beat expectations. However, the Toronto-based metals and mineral producer missed profit estimates. The earnings dropped nearly $75 million. First Quantum says it's still working towards reopening operations at its huge Cobra Panama mine, with the CEO reaffirming a commitment to finding an amicable and durable resolution. TSX pretty flat, but it earlier hit a record high. And let's have a look at the U.S. markets. The S&P, let me just check if it is officially in record territory right now. As I said, we saw a weakness in some of the software stocks south of the border. We're still, okay, we're still slightly down from the record of 6,978 in late January. 27th to be exact. I'm just looking at some of the big traders by dollar value south of the border right now. And we've got heavy volume in NVIDIA, which is up about $4. Micron, the maker of storage devices, up $28. And Tesla ahead. It's hard to, Microsoft has slipped about $4. And Amazon is down just over $1. Investors are looking over a slew of U.S. earnings today. Ford reported a miss, but it did point to an improvement in 2026. And Mattel shares came under pressure after it issued a disappointing profit forecast. We're joined by David Sequeira, Chief U.S. Market Strategist at Morningstar. David, thanks very much indeed for joining us. Let's take a look at Ford stock. Anything interesting for you in these results?
Not really. Now, first, I do have to admit my bias, towards Ford. I'm certainly positively inclined to the company. Mm-hmm. My household, I grew up with a 1966, Ford Mustang convertible. As far as the stock goes, no interest. I mean, our fair value is unchanged at $16 a share, puts it in that 3-star range, meaning it's in the range we consider to be fairly valued. I mean, they are in the midst of their turnaround. They're doing a very good job on cost controls, that allowed them to increase their EBIT guidance, for the year. But we still see a lot of pricing headwinds ahead. They still need to push through, some of the tariff increases, that they've had to suffer over the past year. Mm-hmm. And just overall, when we look at the U.S. auto industry, we're looking for a decrease in auto sales this year. Oh. Our analyst is calling for the range of only to be 15.8 to 16 million. That's a decrease from 16.2 million. So as much as, I like Ford, I just don't have an interest in the stock. And I think there's further headwinds yet ahead that the U.S. auto industry needs to get through this year.
Lyft, you're not impressed with the company right now. You say that it's losing ground to rivals?
Exactly. In fact, we just lowered our fair value to $15 a share from $18, after earnings. When I exclude some of the one-time items that came out, in the earnings release, the growth is definitely below our expectations. And in fact, we see them negatively diverging from some of their competitors, both on engagement and the number of rides. And that was really the reason that we cut, our fair value. So we just think that there's a lot of competitive disadvantages they have, towards Uber. So certainly a stock that I just don't have a lot of interest in at this point either.
What about Mattel? That stock got hammered in the pre-market.
Well, that's the understatement of the morning. I mean, last I saw, I was down, over 25%. Oh, our fair value coming into the earnings number was $25 a share. Our analyst noted in her note that she does plan on lowering our fair value by the mid-single-digit percentage. Admittedly, a very tough holiday season, but we think the market is overreacting to the downside. We think the sell-off is too far, so we still like the stock here. Over the longer term, we think that the operating margins will be able to improve, that they will be able to get, back up towards historically normalized levels, but not yet get back to where they've been in the past. So over the long term, we're looking for an average operating margin, 13.5% over the course of the next decade. Now, historically, those were in more than mid-teen levels over the past, 10 to 15 years. So we still think that it's not going to improve back to where it was, but there is still upside, from here. So probably 10 to 11% operating margin this year, another couple of 100 basis points, yet to come. So I think this is one where it's going to take some time for the company really to prove themselves out. But overall, we still think that the company has, some of the most important brands, in the toy market in the U.S.
They are investing in video games, online video games, and they've released 4 games based on venerable intellectual property, including the Uno card game.
That's also a favorite in the Sakara household with the kids. But yeah, and I think it's one of those things too, as they build out their digital games business, that will actually help improve their mix shift over time. Digital games being a much higher operating margin than some of their legacy brands, the Hot Wheels and the Barbie and so forth. So I think that's part of the reason why we expect over time that they will be able to, start bringing that margin back up. It's just that it was under a lot of pressure, very tough holiday season here in the United States. In fact, if you look at, U.S. retail sales, the last indicator coming out being flat was much below what our economics team was expecting for the holiday season this past year.
Apparently, Mattel is being cautious here. They'll only go in for massive promotions once they feel they have a surefire hit on their hands.
Well, and I think it's one of those things when you look at the operating margins, it's really a combination of not only the promotions, but also the tariffs this year. I think tariffs is one of those things that over the longer term, probably evens out over time. But yes, the promotional activity was probably higher, I think, than what we are currently modeling in for fourth quarter last year. That should also start normalizing over the longer term as well.
And broadly on the market, just remind us of your take, just on the S&P 500 as a whole, in record territory, as you know, David. Do you get a feeling, and I know it's very hard to generalize, that there's too much euphoria in the market?
I don't think there's too much euphoria in the market overall. When I look at our valuations, across the board, the market's probably trading in about a 3 to 5% discount to a combination of our fair values. We use that bottoms-up view. We have intrinsic valuations on over 700 companies that trade in the U.S. So it's trading at a bit of a discount, not enough a discount for me to say you should be overweight equities here. I still think you should be market weight. But when I think about portfolio positioning this year, I expect that we're going to see a lot of volatility over the course of this year. We really only had that one bout of volatility in early 2025 when the markets took, that 20% sell-off and then came pretty much roaring back, thereafter. I think we'll have a lot of choppiness over the course of this year. So I like having much more of a barbell approach to portfolios. I think you need to retain that AI upside, but I would really focus on those AI stocks of those companies that are at the forefront of artificial intelligence technology, the NVIDIAs, the Broadcoms of the world. I'd probably steer clear of those commodity companies, those in the hardware that have really soared, like the Microns and the SanDisks, over the past 4 to 6 months. I'm concerned that those stocks that will probably take some hits over time. I think, yes, in the short term, they were getting great pricing, great margins because there is a shortage. But as they start to bring, more supply on, and cover that demand, I would expect that those stocks, we could see some of the air coming out. But I'd balance that AI outperformance with value stocks. So with that choppiness, I want to have the value stocks in the portfolio, those that can really kind of cushion you to the downside. So if we do get some significant sell-offs, you can use those stocks to sell, raise some principal, being able to reinvest that into AI. Or conversely, if we run too far to the upside, you can take profits on AI and reinvest in those value stocks that lagged behind.
Thank you very much, David. Really appreciate it.
Thank you.
David Sakara, Chief U.S. Market Strategist at Morningstar. Up next, there is the prospect of yet more takeovers in Canada's oil patch this year. We'll have more after the break. Right, we took a broader look at companies that may gain if natural gas demand increases, particularly with this rapid expansion in AI data centers. We were joined by Daryl McCoubrey, Vice President and Senior Analyst at Veritas Investment Research. We kick things off with his thoughts on ongoing mergers in the energy space.
If the kind of widespread concern concerning quarterly consistent supply build or stock build in global liquids markets, if that plays out and the feared kind of trajectory down towards a $50 per barrel WTI kind of environment, I think then you could see some urgency perhaps amongst some players. But on the whole, I still think the real focus here is shareholder returns still. And there's an apprehension, I think, to use the balance sheet to supplement shareholder returns. So I might fear that the reception of an M&A, an aggressive M&A policy, could be looked down upon, even if it's mostly debt funded, meaning the cost of capital is relatively low.
Right. Shareholders might think, well, okay, you've got a nice big company, maybe you get a bigger paycheck for more overseeing more production, but what's in it for me?
That's exactly it. I mean, the sentiment is pretty clear that direct returns through the base dividend, special dividends, and buybacks is what's appealing to the energy investors currently.
What right now, and we're looking at some of the points, you do say that there's a cloud over the anticipated stockpile build in oil, and you're less enthusiastic about liquids. Gas generally is meeting your needs right now, partly because of the anticipated electricity growth.
Yeah, I mean, broadly, globally, transition is kind of defined, the decarbonization by electrification, mostly premised upon wind and solar, winning a lot of market share within electricity markets. AI is just one component of that. There's the EV theme as well. There's potential displacement of kind of direct distributed natural gas with electric heaters. But foundationally, I think the idea is that if it's going to be an electrification theme, there's a bit of a kind of high watermark maybe on some of the resource-constrained technologies like solar and wind, to the extent that once they get to maybe a quarter of a grid supply, they're going to be bumping up against the reserve margin of those grids or the available capacity in the event that the resource-constrained tech isn't available to produce. And so I think that's why you're seeing more of a focus on baseload in general. And then, of course, the kind of 24/7 secure data or power needs of data centers, that also supports more baseload energy. And so the competition really isn't between like wind and solar versus natural gas. The competition is more in the capacity resource market, where natural gas will compete against nuclear. Natural gas might compete against utility scale batteries. And in those arenas, natural gas holds a pretty significant cost advantage currently. And so if electrification is the way and affordability is still a core concern globally, natural gas is an appealing bridge fuel. And so I'd say my preference for gas stocks over liquids isn't so much just AI specifically. It's the cost advantage of natural gas as a bridge fuel to potentially displace solid fuels like coal and liquid fuels like fuel oil that we still use quite a bit of in some regions of North America still.
Just getting on to stocks that you favor right now, Imperial Oil's had an incredible run. I mean, despite a relatively weak oil price, these oil sands giants have thrived. You have a sell on Imperial right now.
Yeah, so there's a couple elements I think at play there. The market, I think, is already looking forward to a worst case where you could see benchmark WTI trend towards US 50 per barrel. In those scenarios, Imperial holds up relatively well. We were assuming a base case price of about US 60, so just a shade below where it is today. So that's one element. The other is, of course, the Exxon ownership, the very low cost of debt, even though they don't use a lot of debt. Having that low cost of debt theoretically should keep their cost of equity pretty low. And also, of course, the risk premiums should be lower because of their integration that provides the defense at lower WTI prices. And so all of those elements, I think, have caused a bid up on valuation for Imperial.
Made it a little bit expensive for your taste.
Well, I think of Imperial as kind of already being owned by maybe the best special interest purchaser it could possibly be owned by. And so that's not necessarily a negative thing, but it is something to contemplate when comparing relative value against competitors who don't currently have that advantage. Because maybe one day a special purpose purchaser comes in and takes out the likes of some of the other oil sands players that don't have an Exxon at their back yet. And maybe they could unlock synergies across the cash flow statement elements.
Up next, we'll check out some of today's notable analyst calls and recommendations. Shares in the drug maker Gilead Sciences hit a record high today. That's after the biotech player reported earnings and earnings per share and revenue for the fourth quarter that beat expectations. Over at Needham, analyst Joseph Stringer has a buy on the stock and is citing a, quote, solid beat. Initial 2026 revenue guide in line and remains bullish on GILD amid revenue growth in the company's HIV franchise and robust growth in the HIV PrEP market. Also, the analyst says the company is keeping operating expenses under control. He's boosting the price target to $170 US from $140. And at Oppenheimer, analyst Matthew Biegler says while he assumed initial sales of the drug Yes2Go would come at the expense of an existing product, that doesn't seem to be the case, with growth mainly driven by expansion in the PrEP market. There are regulatory decisions coming up, and we're looking to an exciting year ahead for Gildan. And then let's take a look at Saputo, the global cheese giant. BMO Capital Markets is reiterating its market perform hold rating on the shares, but raising the price target by $1 to $42. That's after the company's first quarter results. Analyst Etienne Ricard says Saputo continues to reap margin benefits from its initiatives, and that is providing a foundation for future growth. And a lot of the cost restructuring is now in the rear view mirror, the analyst says. So focus is likely to tilt towards product innovation, volume, and a market share. And so you can see those stocks, wow, that stock up 75% in the past year. And then we have seen some pressure on Terravest Industries. This is a maker of industrial equipment. It posted fiscal first quarter compressed gas equipment revenue that missed estimates. National Bank financial analyst Nathan Poe says sales strength in the heating and ventilation and containment segment are related to the data center build-out. Cooling those computers was not enough to offset weakness in compressed gas. The analyst also pointing to uncertainty from tariffs cutting into demand, although Terravest remains, quote, well-positioned. The stock slipping 13%, as you can see. Up next, U.S. President Donald Trump is said to be privately musing about exiting the North American trade pact that was negotiated under him. We'll have more on that after the break. Let's take another look at shares in Allied Properties REIT plunging. That player in office real estate posted a wider than expected loss in its latest quarter. There was more than $1 billion after a write-down and another accounting revision. That was driven by a loss or an increase in losses on investment properties. The company is raising $500 million to try to strengthen its balance sheet. And shares in Shopify, whoa, look at that now, down 10%. That's after the e-commerce giant posted profit in its latest quarter that actually missed what analysts had been expecting. Although volumes and revenue did jump more than 30%. And that the revenue gain topped estimates. Shopify is also buying back up to $2 billion US worth of shares. And Bombardier up about 1%. The jet maker won a 40-plane contract for its Challenger 3500 aircraft from a private jet firm, Vista. The order is worth, on paper, more than $1 billion and will see Bombardier delivering aircraft over the next decade. TSX Composite slipping slightly from yesterday's record high. And we can see the U.S. stocks also down, but the S&P 500 did earlier, very briefly, hit a record high. We did get strong U.S. job numbers, and of course that could decrease the likelihood of the Fed cutting interest rates again in the near future. U.S. President Donald Trump is privately musing about exiting the North American Trade Pact, which was, of course, negotiated under his previous presidency. That's according to people familiar with the matter. It injects further uncertainty about that deal's future as we head into pivotal renegotiations involving Canada, the U.S. and Mexico. Let's get more from Bloomberg Washington correspondent Tyler Kendall. Tyler, thanks very much indeed. Just remind us, what do we know so far, please?
Yeah, hey, Andrew. Well, at this point, people familiar with the matter, as you said, tell Bloomberg News that President Trump is privately mulling exiting the USMCA. This isn't necessarily surprising, right? We've seen a lot of posturing in recent weeks. Plus, there's been real talk here in Washington at this point for months that the administration could be mulling this very decision. At the same time, though, our sources do tell us at Bloomberg News that President Trump has not gone so far as to flatly signal that he will do so. They say he is the ultimate decision maker and no decision has really been made yet. But we did hear from the USTR Jamieson Greer just yesterday, who confirmed that bilateral negotiations are going to continue between the U.S. and Mexico and the U.S. and Canada, noting what has become strained relations in particular when it comes to the U.S. and Canada. Because in recent weeks, we have seen just so much escalation, perhaps started in Davos as Prime Minister Mark Carney and President Trump shared their share of tense words. President Trump then revoked Mark Carney's invite to the Board of Peace. We then saw that 100% tariff threat over that pact with China, 50% tariff threat over Canadian aircraft. And then just this week, of course, the threat by President Trump to block the opening of that critical bridge that could link the two countries. So at this point, we're still awaiting more details, but we have seen a recent trend from this administration as we head into the critical renegotiation later this summer.
Mexico's president, I know you guys are quoting her as saying, we don't believe it. It's never been said in the calls because it's very important to them, meaning America.
Well, at this point, we can point to the fact that President Trump just last month, while he was touring a Ford Motor plant, called this North American Trade Pact irrelevant in his words. We know that he's been getting a lot of pressure from the U.S. automakers that they ultimately want to see some critical changes when it does come to negotiations, including stronger rules of origin for key industrial goods, critical mineral collaboration, worker conditions. The list is really long at this point. And we have to keep in mind, of course, this is a major trade pact. I believe the number is $2 trillion worth of goods and services for America's top two trading partners are uncovered during this. But as you well know, separate trade negotiations have long been tense at this point. While the bulk of Canadian exports are covered by the USMCA agreement, when it comes to those critical sector-specific tariffs like steel and aluminum, we haven't really seen much movement there when it comes to the Trump administration's part.
Of course, as you say, he's known for bluster in advance of making a deal. Of course, that's one of the techniques, isn't it? My dad used to say in haggling, there's the laughing price. When you offer a price, the other person laughs as if you're joking. So obviously a bit of aggression. So perhaps this is just trying to put the fear into his negotiating partners.
Well, I think it depends probably on who you ask in the administration. This White House has before called, for example, some of Mark Carney's moves political noise leading up to these negotiations. So there definitely is a back and forth when it comes to how the administration views itself going into these talks, and it's essential posturing because we know that they're going to be so critical. With that said, our own analysts at Bloomberg Economics think that it is very likely that there is going to be a renewal of the free trade agreement, that it is headed down that path, but there likely will need to be some significant changes. But you're exactly right. This administration has at times changed the policy that ends up being enacted versus what is ultimately threatened. And I will say that as this does get closer, we should probably expect more threats, and we should probably expect the U.S. Congress to weigh in. I'll point you to the fact that there are votes in the House today considered to be very high stakes when it comes to President Trump's tariff policies. Of of course, we're also waiting for the Supreme Court to decide on the broad-based tariffs enacted under the International Emergency Economic Powers Act, which in part impacts Canada. But that vote today in front of the House, if I go back to that quickly, is specifically about the U.S.'s tariffs targeting Canada. So there's a lot swirling around this and a lot that could ultimately impact the outcome.
Tyler, thank you very much indeed. Really appreciate it. Tyler Kendall with Bloomberg in Washington. Up next, President Trump's latest dispute is with Canada over the opening of the Gordie Howe International Bridge. CTV's Mike LeCouture has more on the Prime Minister's response.
Canada, of course, paid for the construction of the bridge, over $4 billion.
Prime Minister Mark Carney said he laid out that fact to President Donald Trump in an early morning call that he described as positive. He also cleared up Trump's misconception about the construction and ownership of the span.
See, there's Canadian steel, Canadian workers, but also U.S. steel, U.S. workers that are involved. This is a great example of cooperation between our countries.
Contrary to Trump's claims, the 2017 agreement clearly spells out that the crossing will be publicly owned jointly by Canada and Michigan. Yet Trump's officials insist there are issues.
There's a question as to the proceeds of tolls, et cetera, and so there's going to be a negotiation on that front.
The agreement states Canada will collect tolls until it recoups the costs related to construction. After that, they're split between Canada and Michigan. One former ambassador says there's a reason the president gets things so wrong.
You've got a bunch of crackpot advisors in the White House who misinform the president, who already likes to have tantrums and lash out.
The New York Times is reporting the owner of the older Ambassador Bridge, Matthew Maroon, lobbied the Trump administration on the same day the president unleashed his tirade about the Gordie Howe span.
The Maroons are the only party that benefits from delaying the bridge. They make a lot more money at the expense of Canadian and American consumers and everyone else.
Ontario's premier believes there's an economic argument for the new bridge, which could spill over into the American midterm elections.
If, the 13 Congress people, 7 are which Republicans, they start getting hammered by their constituents, watch how quickly they flip.
But before that happens, Prime Minister Carney says President Trump asked his ambassador to Canada and Michigan native Pete Hoekstra to continue the conversation and bridge the apparent gap.
CTV's Abraham Gobriel gauges reactions from businesses that could be affected by a delay in the opening of the Gordie Howe Bridge.
Spanning 2.5 kilometers across the Detroit River, a long-promised economic driver could be forced to take a detour.
We're home to the busiest commercial border crossing between the U.S. and Canada. This is insanity.
While President Donald Trump's political speed bump threatens to derail the planned opening of the commercial corridor, some industry leaders see an opening to accelerate negotiations.
As of a few weeks ago, conversations weren't happening between U.S. and Canada. They were stalled.
Nicole Vlanich, the executive director of the Canadian Association of Mold Makers, says the U.S. president's bluster doesn't surprise her, even though Trump has previously supported the project. This joint statement, released by President Trump and then Prime Minister Justin Trudeau in February 2017, says that we look forward to the expeditious completion of the Gordie Howe International Bridge, which will serve as a vital economic link between our two countries.
It's right. I mean, it is vital. I think we need the second bridge. It's been talked about for over 20 years why it's needed.
Political leaders in Windsor and Michigan say they're united by a common goal.
This bridge will open. It's fully constructed.
It is important that it continues to move forward and open up on time.
What would any delay to opening this bridge mean for your industry and the industries here in Windsor, Ontario?
When we think about job growth and job potential on both sides of the border, it would delay that.
The bridge is expected to increase the current $1 billion per day in trade that flows through the Windsor-Essex region, while creating a smoother commercial alternative to the Ambassador Bridge.
There's an issue with one bridge, they can go to the other. It'll stop the traffic delays.
With negotiations now reopened, the hope of many here is that a clearer path will be paved for future economic growth.
Some local business leaders here, as well as politicians, believe the Gordie Howe Bridge is simply being used as leverage by President Donald Trump as he pushes to negotiate a wider America First agenda. Adrian Gobriel, CTV News, Windsor, Ontario.
Up next, hot picks, and we are going to zero in on robotics stocks. We'll be right back. Time for hot picks, and we're zeroing in on robotics stocks. Our guest has Ondas as his top selection. Just looking at their website, pretty scary. They're involved in military drones, among other things. He sees growth for the company amid demand for commercial drones as well. We're joined by Zeno Mercer, Senior Research Analyst at Vetify. Thanks, Zeno, for joining us. Fascinating company, Ondas. They're also involved in counter-drone technology. Tell us where you see growth, please.
Yeah, so Ondas is a company we've been following with RoboGlobal and Vetify for many years now. And I'd like to assuage any fears around the scary elements of Ondas. They're actually more focused on kind of as you said, the counter side, like defense, not in traditional sense of attacking, but in the sense of we're going to see, as technology evolves, as we're seeing more AI and robotics applications, we're seeing new addressable markets expand and also new attack vectors. So Ondas has a mix of products. They've been rolling up companies over the last, let's call it 5 years. And now, so they do, monitoring for, railroads inspection. So they have kind of like a classic communications and inspection angle, but they also have counter UAV. So not attack drones, actually defending against drone threats. And as an example of that, they recently scored a contract with the Israeli border. And that's just one of many potential borders around the globe they could lock into. On that same subject, they're also bidding for things like the World Cup, the Olympics, and other things like that to help protect other assets like airports, stadiums, et cetera. So they've got a really interesting mix of ground and air robotics and control systems. And they're definitely right now a smaller company, but in that $4 to $5 billion range, but they have lots of opportunity to continue to grow into kind of that, let's call it autonomous robotics as a service market.
So these drones would be self-directed to a large extent?
Yes, they have a mix of autonomous drones that can sense, analyze, and act, let's say if there's a threat coming. But they also have other products too that are supervised. And let's back up a little bit. They're all supervised, so they're not fully autonomous in the sense that they're connected to a system and a network that whoever is the purchaser or holder of those assets can manage. But again, we're entering an era of let's call it hybrid autonomy, where we're using assets like this for a number of different things. Like as an example, they scored another contract and have a division for demining. So, not mining and creating weapons, they're actually helping eliminate mines that are in, Israel and, potentially places like Ukraine once the war is over.
That's interesting. I was watching a spy show with my wife last night, and we were wondering, will facial recognition change the spy business? Because if you want to check somebody out now, you can really, you can do it much more easily. I guess they'll be putting facial recognition on drones, but I bet they are already.
Yeah, I would say that technology has been implemented for quite some time now. I mean, police force uses it on cars and scan license plates, facial scanners. I mean, you're going to have to do a lot more than even just wear a mask at some point from that element. So that's a whole different element or angle of computer vision advancements.
SoftBank, we think of them as a merchant bank, a major investment in tech stocks. Tell us what the robotics angle is, please.
Yeah, so exactly. But traditionally kind of telecom and then VC angle. Over the past 2 years, though, we really believe and see kind of this new framing and angle, vision taking shape. Obviously, they have their ARM position, which makes up a lot of their current valuation and is a great proxy for kind of this AI play. Now, AI is distributed in the physical world. We're going to keep hearing conversations around physical intelligence, which is essentially AI acting on objects in the real world, aka robotics. Now, SoftBank also acquired ABB Robotics last year. And so now they have an actual robotics angle. They've got a green box. They've got a joint venture with Symbotic, another player, which actually was I think a year and a half ago, one of my top picks back in the end of 2024. They have a partnership with Yaskawa for physical AI, which is a Japanese, makes sense, another Japanese robotics company that's also in our Robo Index, ROBO. And again, they've got these 4 pillars. As he says, they've got AI chips, AI robots, data centers, and energy. And those are actually really, many would say, the 4 pillars of what a lot of GDP will be comprised of, is things that excel in those 4 areas.
And finally, an outfit called Novanta. What's their robotics angle?
Yeah, so I kind of wanted to include an angle that's a little different than maybe the application side of things.
Right.
Novanta is very much like a picks and shovel of robotics and physical AI. So they work in precision motion controls, machine vision, photonics, and a lot of tactile touch sensing. As an example, their biggest customer and segment is in surgical robots. And so what we see is if they can excel in surgical robots, and we see these new robotic applications coming, they're in a great position to be involved in and have upside that's really underappreciated in areas like humanoids, drones, and these other markets that are starting to appear. And in fact, in October, they hosted a, let's call it the Humanoid ISO Safety Standards Working Group. So this is clearly an area that they're looking for, but they really haven't, let's be real, they haven't started to get that upside in the numbers, but we think it's just a matter of time.
Fascinating. Yeah, just an exploding area. And I guess all of these companies are possible. Well, maybe not SoftBank, but Ondas and Novanta could even be takeover candidates for a company that wants to boost its robot portfolio.
Yeah, and I think we're going to see a lot more M&A over the coming years. Obviously, robotics is in the spotlight. I think everyone's talking about it, from big tech. Even the U.S. government is looking at having a national robotics strategy. There was a bipartisan bill introduced last week. We really are entering, let's call it, this Cambrian explosion moment of robotics because of that convergence of AI chips and new form factors and like world models coming together to increase the capabilities and coordination and management of these robots.
Oh, that's interesting. A Cambrian explosion, that period when species multiplied. Yeah. Thank you very much indeed. Really appreciate it, Zeno.
Thank you.
Zeno Mercer, Senior Research Analyst at Vetify. Coming up, one last check on the markets, and we'll tell you about some of the companies that will be reporting after the bell today. Yesterday on Market Call, we were joined by Julien Nonowamdim, VP Equity Analysis at Goodread Investment Counsel. His focus, U.S. stocks, and his top picks were Citigroup, Celestica, U.S. listed, but technically Canadian, and Merck, MRK. Joining us today on Market Call is Chris Blumas of Raymond James Investment Counsel. His focus, North American large caps. It is going to be a busy after-hour session today. We've just been checking Bloomberg for the companies expected to report when the market closes. And in Canada, they include Sun Life, Precision Drilling, Great-West Lifeco, GFL Environmental, Birchcliff Energy, Wildbrain, Manulife, and West Fraser. And south of the border, we're looking for prominent names, including Cisco, McDonald's, Albemarle, the lithium giant, and Kraft Heinz. And that stock actually came under pressure today after the CEO indicated that the plan now is to call off that breakup of the company. They had planned to improve valuations by dividing the company in two, but the new CEO says that that plan is now on pause. And so we did see some selling in KFT. Let's have a look at the TSX, see has it managed to get back into record territory. And we are down a little bit right now. And of course, Shopify is a heavily weighted stock, and it has lost some altitude. That's interesting. Of course, the revenue growth impressed investors earlier, but it looks like profit, which was on the soft side, is turning investors off. So mixed trading. They generally beat fourth quarter results, but adjusted earnings falling short of forecasts. I'm just looking here. Yep, they earned 48 cents on an adjusted, diluted basis. The stock had rallied this week, going into the print. So down now, you can see, wow, just over 10%. And of course, there is still pessimism over software companies. We heard a fascinating interview earlier arguing that Shopify will be a big winner from so-called agentic AGI, but we are seeing some selling in software stocks. Let me just have a quick look. Adobe, last time I looked, was down, falling to its lowest in at least a year. Yeah, Adobe. Thanks, Control Room. The slide goes on for that software stock. Allied Properties investors not thrilled by this plan to recapitalize the balance sheet by issuing $500 million worth of shares. They also posted results that disappointed investors. You remember, for a long time, they insisted, no, we don't have to cut the distribution. And then they finally did reduce the distribution. That stock's sliding. And Michael Emery, the founder, he's listed as founder and chairman, former CEO, is leaving the board. So I'm not sure what the circumstances behind that are, but I'm not sure why Michael is moving on. Okay, let's have a look at Gibson Energy planning a big acquisition. And this is a major player in stored oil. That stock's been doing well, up again to, I'm sure it's hitting its highest in at least a year. They are extending their empire in Alberta, their so-called Hardisty platform, by buying an outfit called Chauvin Infrastructure Acquisition, and the price is $400 million. And they're also issuing $200 million worth of stock to help pay for that. Bombardier winning a $1.2 billion private jet order from Vista, which is a company that based in Dubai, Vista, that helps you avoid the trouble and expense of owning your own private jet. They'll handle all that for you and rent it out to you. Cineplex, revenue meeting expectations, but attendance not matching analyst estimates. And the average person spending almost $10 on concessions at the popcorn stand. Of course, that's a huge source of profits. I remember Ellis Jacob, the company boss, telling me years ago he wished companies or studios would release movies with intermissions because people would go out then and spend on snacks. So the stock down marginally right now. And let's have a look at Lyft, because David Sequeira of Morningstar told us that he's pessimistic about the company, says that it's been losing market share, importantly. I've never been a big Uber rider, but I've been on the subway lately, and they were going to put us on shuttle buses after the subway broke down. It's usually Stalingrad-like scenes when they do that. Lineups in the snow, and I just called an Uber. I ain't riding those shuttle buses again. And I think we're out of time. Tomorrow on The Open, we've got a great guest, new head of YouTube Canada, going to hear more on her goals and how the company plans to stay on top of the competitive content creation landscape. We got to wrap up this edition of The Open. Morning Markets is next.